Hello, welcome back. One of our subscribers asked to make a video about new holdings, and this is actually a bank, and I believe it's a Brazilian bank. And so I wanted to take the opportunity to make a video about it and explain how different it is to analyze a bank company. Now, I have done videos about it before. I have analyzed Goldman Sachs, for example, or JPMorgan, and it's a little bit different. It's actually drastically different how we analyze bank stocks. The problem when we're talking about companies that are handling money in the sense of debt is that they get a lot of debt themselves. So they are actually debt leveraged companies, and so you will see a lot of skewed values in their income statements and free cash flows, just because their whole operation involves pretty much utilizing debt, a lot of debt. And so we cannot really judge a company of that sort by taking a look at PE or the free cash flow, because again, it can be completely skewed, and it's gonna be tough to to understand whether that's actually fair what we're analyzing when we look at these values. We're probably going to be way off, and so there is a different methodology that we can use for actually understanding whether it's worth it to buy a company that is a bank. And typically, when I look into bank companies or banks, pretty much, I like to analyze and compare them as well. So I want to be looking at one bank when compared to another bank. And that's not the only thing, of course, because I need to have some absolutes. And one of the things that I really like taking a look at is book value. This is the assets of the company after all the liabilities have been paid. And this is a very important metric and very good thing to examine when we're taking a look at a company of that sort, a financial company, because we want to see it increasing its assets over the years. Now they could be handling debt and all that, but we want to be seeing them increasing their assets again based on what is the current value of the stock. And so Warren Buffett, for example, has been buying companies when their book, like bank companies, for the most part, when their book value is below 1, for instance, the price to book value. And what does that mean? I do have a couple of diagrams here. One of those is new holdings here. The other one is Bank of America. So as you will see right now, you can see in this chart that we have basically two lines. This orange line, and you can kind of see the colors here, is the price to book value of the company. And these candles represent pretty much the price of the stock. Now you will see here that at some point new holdings was about 19 over here, 23 over here, 23, that is 23 times of a multiple for the price of the company, 23 price to book value. And what is price to book value? Now price to book value basically is price to book per share. And this implies that for every, for example, if it's like 23 over here, for every $23 that we pay to purchase the company, we are getting $1 of assets from the company. And so as you can understand, we want this value to be as low as possible. So if it's 2, it means that for every $2, we're getting $1 of equity from the company of book value. And so typically speaking, as an investor, and especially as an investor in these kinds of banks where we don't really have a lot of information about their financials, and unless we are a board member, a lot of their things are going to be unknown to us. Of course, you could spend the time to take a look at the 10K and understand more about it, but it's going to be very complex. We do want to be getting more from our money. And this is a thing that applies to other companies as well, but I don't use it that much for other companies because there are a lot of other factors, like for example, free cash flow that the company is generating, or revenues, or net income, all these things. But here, I cannot use all these metrics because they will be heavily skewed when we're talking about a financial company. This happens with insurance companies as well, by the way. So, what are we going to do here? We will actually examine the average, what the company has been doing here for the most part, and where we are right now. So you see that typically the company's book value was actually very high, sitting at 15 here, 21 here. Currently it is at 8.2, as you can see over here. 8.2 is the price to book value. And then I'm going to actually take a look at a competitor which is not from the same country, but doesn't matter. I want to see how other banks are doing. Now, Bank of America, for instance, let's take a look at this bank. You will see that, generally speaking, the price to book value is similar to what the prices of the stock is doing. And this is a very, very typical thing for banks as well. You don't see too many radical changes between the price to book value and the price of the stock for the most part. And when you see these kinds of discrepancies here, it can be a little bit weird, for a company, for a bank really. But the thing is, we want to be buying a bank whenever it's as low as possible in terms of its price to book value. And so the best actually time to buy a bank would be when the price to book value is below 1. And over here, you'll see that it hasn't even happened for Bank of America. It used to be 1.3 a few days ago in March 7 of 2022. But now it's 1.4. Still not that high, but higher than what it was. But if we go back in time, you will see here, for instance, in Bank of America, look at this over here. Let me take it back. Over here, for example. Now here, it used to be 0.7 times of price to book ratio here, 0.7x. And so at this point would be a fantastic opportunity to buy Bank of America, which was pretty much below its book value. This means that we're actually paying less for the stock price than the assets of the company per dollar. So we're paying 70 cents in this case for $1 of assets from the company. And as you can see, this actually followed with a steep increase in price after some time. And then, it had a little bit of downtrends in some points. This happens, and this can happen. Now, let's take a look at a different company. Again, let's take a look at the JPMorgan, for instance, JPMorgan Chase. Now here you will see a company that is, it hasn't been reflected yet. Okay, so here you will see that JPMorgan Chase is again sitting at a relatively low price to book value, 1.6 right now, and it used to be 1.5. And if you go back in time, you're looking at it at 1.2 times earnings. And as you can see from the chart, when the book value of the company was at 1.2 times book assets, not earnings, I said earnings earlier, my bad. So when the price to book was 1.2, the company's price, as you can see on this little dialogue, was $94. And this would be a good opportunity to buy the stock, if not even less than that, if it actually reached at any point. So probably over here, I suppose it was, we don't have the price to book for that far. But what I want to say here is that you need to be getting, when we're talking about a financial company, you need to be getting it, if possible, near 1 times price to book value. So you do want the price to book value to be 1.0 times or less. So you typically don't want it to be more than that. And you may consider getting it at 1.1 or 1.2 if you don't want to wait for some reason. But I myself would pretty much buy a bank only if it was below 1 times 0, or 1.0 times price to book. Let's take a look at another example. Let's take a look at Wells Fargo, for example. You will see here that again, Wells Fargo is sitting at 1.2x price to book. And now you may understand why Warren Buffett was looking into this one. Or look at this over here, 0.6 price to book. So this is when you buy a company of that sort. When it's trading well below its book value, this is when you want to buy it. So what's happening with New Holdings here? Is that trading near 1.0? No, it's actually way, way higher than this. And so if I'm an investor and I'm looking at this, I immediately pretty much ditch the company and the stock. I'm not interested because it's expensive for my taste, and I think I can use my money in something better. Now that doesn't mean, of course, that it won't reach higher levels at some point, but it's not going to be risk-free. That's the thing, because as it is right now, I wouldn't enter, and I'm pretty sure a lot of people, a lot of actually investors that have a lot of money would be looking at this price to book and would be like, okay, this is very, very expensive. Why would I pay 6.2 when I can pay 1.2 right here for Wells Fargo? Or a few years ago, I could have paid even less for Wells Fargo. So why not just wait? Why would I invest here? And this is what I would think myself. And so just looking at the price of the stock can be a bad thing to do, because it used to be higher. Of course, it used to be near 11, and you may be looking at this and be like, okay, it's like 40% down. But again, the amount that the company has been down in terms of its stock price is relevant to what the company has been doing financially. We want to have some metrics that are objective, and this is a good way to actually analyze companies that have to do with financials, and their whole business is about debt and liabilities. So hope that helped you a little bit, and thanks a lot for suggesting this company. I think it's an interesting one, and it's different than what I typically do in terms of analysis, because again, I cannot use my typical discounted free cash flow models and things of that sort. They don't work well with these types of companies, and I just want to provide value here and not just do nonsense. So this is how I would analyze a company of that sort. So hopefully that helped you a little bit. And for all of you guys, hope you found the video to be interesting, and if you did like it, please leave a like and subscribe if you're not a subscriber already. And if you enjoy these types of videos, you might want to take a look at this video that I made earlier, and I'm discussing Alibaba and what it is doing financially right now. So thank you for watching, and I'll see you soon. Bye bye.